Hello and welcome to another Macro Monday. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
My name's Harry Nedeljkovic. I'm a research analyst here at Onyx.
Today I'll be discussing last week's weaker than expected data across the board. We'll be discussing the data that's coming up in the week ahead. We'll be looking at charts and talking about current market risks and trends.
I'll also be going into the elections we had this week. So we had the UK's general election on Thursday and we had the second round of France's legislative election yesterday.
So on to the data. The first piece of key data out of the US last week was the US Manufacturing Purchasing Managers Index. This fell yet again. ISM PMI fell to 48.5, still in contraction, expected at 49.1, but came in at 48.5. It's only been above 50 in expansion once since September 2022. Within that, we saw employment falling from 51.1 to 49.3. We saw prices falling aggressively from 57 to 52.1. And new orders jumped from 45.4 to 49.3, but these are still in contraction.
Just going to ask about that. Would you see this as a result of the dollar being strong at all, or would you think that'd be explaining different things?
I just think the economy is slowing. I think this is the result of interest rates being higher for longer, and now they're having an impact.
Interesting.
Again, we have seen the manufacturing contraction pretty much non-stop since September 2022. What was the big unexpected event last week, really, though, was the second piece of data, the US ISM Services PMI. This fell to a 4-year low, and this is critical because it's been the service sector that's kept the US economy afloat in the last 18 months, and the service sector is 3 times bigger than the manufacturing sector. So again, ISM services fell to a 4-year low. The ISM chairperson Miller said, and I quote, "The June services PMI indicates the overall economy is contracting for the first time in 17 months." So the extent of the contraction, the services PMI expected to come in at 52.7, came in at 48.8, much lower than expected. A huge contraction in business activity from 61.2 to 49.6. And also new orders, I should say, fell from 54 to 47.3. These are pretty big, pretty shocking moves.
Especially business activity. 61.2 down to, how would you even explain such a humongous difference?
Well, what we've seen really, it's the middle of April that the economic surprise index started to fall aggressively. So the data now for at least 2 to 3 months is coming in significantly weaker than expected on every single data point. And then as we move through the week, on Thursday we had secondary employment data, so jobless claims and continuing claims. Again, these were both weaker than expected, which brought us to Friday's key data of the week, employment, US employment data known as non-farm payroll. Now, the expectation from economists was that payrolls would create 180,000 jobs, and the headline came out, 206,000 jobs were created last month. So the algorithms immediately reacted to that. That looked like good news. But when we drilled down into the detail, this was also significantly weaker report than the headline suggests, because firstly, the previous 2 months payrolls revised down 111,000. So significant downward revisions to previous months. Secondly, the unemployment rate rose to 4.1%. Now, it was just 2 or 3 weeks ago we had a Fed meeting and they said they expect unemployment rate to stay at 4% till year end. We've already jumped now to 4.1. And what I think was the biggest point here, full-time jobs on the month fell 28,000, but how about this? Full-time jobs in the last year have fallen 1.55 million. This has always been consistent with a recession in the past.
It's just looking pretty, I wouldn't say bleak yet. I'd say the charts we just looked at were more bleak, but this is potentially an indicator of exactly the same in employment and
it's trending in the wrong direction.
It really is.
Yeah, the economy is still positive. GDP is going to come in positive for Q2, but it's definitely expectations are coming lower and the economic data is clearly trending in the wrong direction. We'll come into what's being priced in the OIS in a second, but we'll just look at 2 or 3 other key data points. Inflation, again, coming in across the board, lower than expected. German CPI fell faster than expected, 2.2% year on year, right by the ECB's target. Expected to come in at 2.4, it's 2.2. South Korean inflation falling faster than expected. Expected 2.7% year on year, came in at 2.4. And Euro area PPI fell 4.2%. So clear deflation in PPI in Europe. Is there a trend here, Harry?
There definitely is. It's just inflation's falling faster than expected on virtually every metric, and every growth metric or employment metric is worse than expected.
Which would lead us to central bank cuts.
It should.
Just before we get there, though, one other piece of data worth highlighting, the German economy. Factory orders unexpectedly fell 1.6% month on month. Expected to be positive, 0.5%, and they fell 1.6%. Then on Friday, German industrial production fell 2.5% in May in 1 month alone. So German industrial production has now contracted 9% in the last 10 years. This used to be the 3rd biggest economy in the world.
It's crazy, especially for industrial production. It was predicted to increase by 0.2%. Obviously not a big increase, but falling 2.5%.
These are huge
month,
misses.
It's just absolutely.
And the data's turned on a sixpence in the last couple of months.
It just begs the question, is there anything they can do to fundamentally change their trajectory? And it seems like high energy costs deriving from not being able to get cheap gas from Russia anymore and not having domestic nuclear power from about 2011 when I believe it was phased out. It's just harming them, and I don't really get where the impetus for growth is going to come from.
And also car sales are falling. China's coming in. BYD is a massive... So German cars are not being sold in China. Chinese cars are now being sold in Germany. Ironically, BYD is one of the lead sponsors of the Euro football.
Yeah.
Which is probably going down pretty badly.
And Germany went out. Even worse.
England are still in, but football's coming home, I'm not going to say with much conviction.
Yeah.
At which point we should move on to the OIS.
Yes.
So central bank cuts on the horizon. Interestingly, the US, you can see here, 49 basis points of cuts priced by year end. What I find slightly more intriguing from a trading perspective, there's only 19 basis points, or exactly 19, priced in for the September meeting. Now that surely is going to be a full 25 at least, which means the market's going to start sniffing at 3 cuts possibly this year, because if you get a full cut priced for September, the market will start pricing 55, 60 for year end. And personally, with the data coming out, I think the OIS markets should be pricing more aggressive cuts. If we look at globally central banks, the ECB, such weak data and inflation coming into line, just 41 basis points of cuts by year end. I would be trading that, receiving that, looking for at least 2 cuts. Bank of England pricing 2 cuts, 49 basis points. Interestingly, on the RBA, the market's still looking at hikes with the stronger inflation data there. I think the RBA would find it very hard to raise rates while other central banks are cutting, and I'd expect the data to continue, the non-inflationary data in Australia to continue to weaken. And the BOJ on its own, 1 more hike expected this year. The yen has stabilised now, I say stabilised, at a very weak level, at around 160 against the dollar, basically because US data is now coming in weaker, so the US dollar's weakened slightly.
I think it's probably worth mentioning, at least for the Bank of Japan, 20 basis points compared to what their current rate is actually pretty major, whereas obviously overall like a 50 basis point cut for the Fed still takes them to around 5%.
Yeah. And the real concern for the Bank of Japan is if the further down the curve the 10-year steepens, because the central bank are by far the biggest owner of Japanese government bonds.
And I'm sure they'll be, I don't know what point they start to get concerned about having to intervene, And at what point they look like a real, not like a full credit risk, but at what point the US is going to tell them to essentially stop intervening aggressively, and how much can they afford to keep doing that?
But the one point for Japanese economy, the currency so weak, it's great for exporters.
Fantastic for exporters and for tourists.
Yes.
But then I know that they're starting to have some problems with just the sheer number of tourists that want to go. Obviously, like, flights are still expensive, but once you go there, it's basically like southern Italy level of prices now.
Unbelievable. I lived there back in 2000. It's so expensive, and now it's changed. But also it makes it a great country to invest in.
Absolutely.
Let's move on to the elections.
Let's. Okay, so starting with the most recent election. So absolutely, well, I could say crazy results, but really unexpected results for the second round of France's legislative election yesterday. So it was the first round last week with the National Rally getting by far the biggest number of seats and also by far the biggest number of votes. Fast forward to yesterday's election, really the key point is that Macron and his Ensemble coalition wanted to do anything possible to keep the National Rally out of power. And it seems like his gamble has I could say somehow worked, but it worked through standing down 224 candidates across France. So all of the runoff elections we had yesterday resulted in the National Rally only getting about 140 seats when initially they were predicted about 250 to 300. This came despite, so the National Rally got 37% of the vote. The NFP, the left-wing coalition, got about 26% of the vote, and Ensemble got about 25% of the vote. So despite the National Rally getting way more votes overall, they got about 10 million to the NFP's 7 million and Ensemble's 6 million. That just didn't get reflected in the parliamentary makeup. So they only got 140 seats versus the NFP's 180. And what does this mean for markets? What does this mean for France? It means that the most likely outcome is it's an NFP prime minister, whilst Ensemble are sort of supporting them with votes. So what this will mean is Macron as president will only really get say over foreign affairs and defence, whereas the NFP will be able to essentially like have control over the domestic agenda, which they have everything from very centre-left to very far-left groups. It's interesting to see how that will translate into policies. They've already committed to a lot of extra public spending, but markets have responded positively in the short term. So both major like European and French equity indexes are up by about 0.5%.
Would Macron take this as a victory?
He would overall. So I don't know if his plan is still to call another snap legislative election next year, but his sole aim was to keep the National Rally out and hope that their vote share and their support fades by the time of the next election. But from what he wants to achieve with this one, absolutely.
Surely there has to be certain concerns across Europe with left wing coming in about spending.
You'd hope so. Saying that, the National Rally were also broadly similar to the NFP. So whilst the NFP is even more public spending, the National Rally are by no means they're not the equivalent of a Reform UK in terms of like right-wing populist party. They were really still committed to you could probably say like sort of socialist style economics. And yeah, like expect French deficit to keep increasing. That's probably what I'd say about that.
Which is not good for the euro in the long run, or French debt.
Absolutely not. No, especially French debt. So whilst France is really about to enter a period of uncertainty where majorities in Parliament can't be reached, the same absolutely cannot be said for the UK. So Labour in the general election on Thursday absolutely wiped the floor with their opposition. So despite only getting 33.8% of the vote, which is the lowest percentage needed to win, to be the largest party in a long, long time, at least since 1945, They won 411 seats and 172 seat majority. So really just huge.
So can I just ask you about that chart? So they got
Absolutely.
34% of the vote, but won 65% of the seats.
They did.
That's astounding.
As you can see, so that's the largest spread, at least since 1945 again. According to, so there's something called the Gallagher Index, which records the disproportionality of voting in democracies. And this, well, the UK's general election and this split of 65 versus 34% is the the second most disproportionate election result in any advanced democracy ever, behind only the 1993 French legislative election.
I'm amazed because we knew beforehand it was going to be a foregone conclusion.
We did, but I would take this as seeing it's really not a sign of Labour's strength at all. It's just a symptom of the Conservatives' bleeding votes to reform.
So if those reform votes had stayed with Conservative, this would have been a lot closer.
Absolutely, it would have been a normal British election. So as you can see from there, the sort of average percentage needed to win is between like 35-45%. If the Tories could just have managed to keep themselves on, even they got 43-44% last time, so even if they stayed on like 35-36, they'd still be bigger than Labour. And another thing about Labour's vote share, so Labour actually got their own fourth lowest number of votes since 1945. So even, Corbyn in 2017 got about 3.1 million more votes. This did happen under low turnout. It was only a turnout of 59.9%. But still, I'd say the main takeaway of this is, and the Greens and Reform are the biggest proponents of this, but you've got increasing number of voters calling for an overhaul of the first past the post system. Because when you can get such a huge parliamentary majority with only 9.7 million votes, it's bound to lead to questions like that, of people thinking we're genuinely not represented by the party we really want in power. But that's the system, that's how it's worked since its inception, and there's no signs of that changing anytime soon.
And why do you think turnout was so low? Is it because people thought it's a foregone conclusion, my vote won't count?
I think so. You could also put it down to just uninspiring party leaders. I don't think there's been a time where that's been as true. I know that's probably a reason why some people think Reform did well. They see Nigel Farage as at least a personality, if nothing else. But yeah, like the word managerial, I think, has come into the public debate about both the Tories and Labour. Interesting.
And actually, from a market's perspective, there was no reaction because it was all predicted beforehand. Oh. If anything, the pound's done a bit better because there's more stability potentially.
I think it's going to keep on going. I think especially when you've got France and Germany in pretty precarious situations, I think the UK, regardless of what the government does, is going to stay pretty stable for at least the next few years.
And the US data weakening, the pound, potentially is a medium-term winner.
I'd say absolutely. The UK might not be doing that well, but relatively should be doing all right. Although Keir Starmer has committed to, you can commit to it, but his aim is to get 2.5% annual GDP growth at least by the end of his first term, or maybe final term, who knows.
I love Prime Minister's promises. Let's see how that turns out. Excellent, let's move on. Interesting chart last week, a power surge. So computer failure and exchange led to electricity prices spiking 3,000% above normal levels for a few hours in Germany. And probably raised a few eyebrows, the regulators.
Well, does that end up being refunded? Or will that ever be equalised with what the rate technically should have been?
I don't know the answer to that, but that's a risk in these markets. We're seeing more traders in these markets pulling out and, again, wanting the regulators to take a stronger control. But that's just not a good market to be involved in.
It's just rough for Germany.
Yep. Moving on to chart of the week. So several options here. I thought about looking at the dollar index weakening, but then it's tough against which currencies you pick against. I looked at silver, which is now in a strong rally again, over $30, 30.9 I last looked. Another one was Bitcoin going down. Bitcoin's now down 23%, no longer going to the moon. But I chose the 2-year bond yield because it's broken 2 key support levels. One's a long-term rising trend line, and secondly, the short-term lows at 4.67. And you can see it's trending lower. So the market's buying bonds, yields are going lower, and this is off the back of the weaker data. And I think once you start to see trends, what I find with the data is when data starts trending, it's very hard to reverse that, because how can you reverse economic data? Literally by central bank policy, and they're not moving till it looks like at least September. Rates higher for longer, they want to get inflation under control, so it looks like economic data will keep weakening, so I think yields will continue falling.
Would you say job done on inflation?
I would, and all the forward-looking indicators say job done, but the central banks are being humiliated, and I think they want to see absolute whites of the eyes inflation as close to 2.0% in the US. Certainly Europe's almost there. That's the big
Definitely.
trade really, is will they go before inflation gets to target because the economy is weakening? It is a dual mandate. It's inflation but also economic growth.
I think, yeah, it's just going to be hard to, well, it'll be really interesting, as I'm sure you're waiting for, which is the first major bank to cut maybe more than expected, and then see what the knock-on effects are, especially if the Fed does something.
We've had surprises with the Swiss National Bank, I guess, and Bank of Canada, but I'd expect to see more weaker data. And if we go on to key data releases this week, I've jumped to this because on Tuesday we do have Fed Chairman Powell testifying. Again, we'll hear it from the rhetoric first, what they're thinking, but personally I think September's a done deal. 19 basis points of cuts priced to the OAS. To me, that looks like a really good risk reward.
Yeah.
I could see the market even starting to price 2 cuts at September. We have nearly 3 months to get there, 2.5 months. Plenty of time. On Wednesday, we have OPEC monthly report and China's CPI and PPI. Again, we've not mentioned China today, but that economy's been consistently weak. That's been teetering with deflation.
Since on a topic we discussed before as well, new car sales. So massively down in the UK, massively down in the US, also massively down in China. So even with electric cars might be doing extremely well and their market share's increasing almost exponentially, in absolute terms, new cars are just
and that's consumer
not doing
sentiment.
too well.
If people are feeling affluent, they're happy to buy cars. If car sales are falling aggressively, then people are putting their hands in their pockets and saving.
I couldn't believe it was the average cost of a new car in the UK is over £40,000, and on the used car market it's like 16.5. So who's affording £40,000+?
What we'll see soon is some discounts coming in pretty quickly, because if sales are falling, what do car companies do?
And then you'll see inflation potentially fall even more rapidly.
Definitely. Which brings us to Thursday, is probably the key data point of the week, US CPI. Also UK GDP and industrial production. And then on Friday, US PPI and University of Michigan consumer sentiment. Anything stand out to you there?
Well, US CPI, it's going to be really hard to ignore what that says. If that doesn't come in lower than expectations, then got a real bit of an issue on. I think, yeah, if something massive happens there, then expect to see the Fed cut a lot sooner than expected.
Absolutely. So the key charts I'm looking at, the 2-year yield, silver, that's bouncing. Currencies is a tricky one. I guess back to dollar yen, because if dollar yen is not going higher,
If the trend that
sideways is a new down, potentially.
I remember discussing that back in like February, and it seemed like, oh well, the yen should strengthen given interest rate differentials, and now it's potentially the same thing after it's fallen 20% since then.
And a key point is the market is massively long. So when it does start to fall, all of a sudden you see exaggerated movement with all these longs and forced to stop out.
Would you think, yeah, it potentially could already be saturated long?
I think it is. It's when you start to see forced sellers. And the other point as well, we haven't touched on equities. Equities normally fall when the Fed start cutting. So back to a point I keep highlighting is going back to 1970, the low of the S&P is typically 11 months after the first Fed cut. So when the Fed start cutting, that's when equities start to fall. We were discussing it just before we came on. I remember back at the NASDAQ bubble, before your time, but I remember I was in employment then. I was living in New York. The NASDAQ fell something like 80%. Can you imagine that happening now?
It almost seems like a foreign concept. I was saying to you as well, the same sort of applies to house prices, so especially in the UK, where for the entirety of my life, it's just been constant house price growth, with the exception of like 2008. It's almost unimaginable to think what would happen if house prices dropped like 30%.
And that would be desperate for governments because consumer sentiment would plummet. But you look at the other side of the world, you have 9 million empty homes in Japan and you have 60 million unsold homes in China. Unbelievable situation in different countries.
Well, I think it might be, well, you could argue necessary for freeing up capital in the UK. Because if real estate itself is no longer just a perfect asset where you just put your money in and then you'll double it in 7-10 years, and you have to then invest in productive businesses, you could potentially see the FTSE start to recover, at least in comparison to like the US.
The other interesting thing, if we see a recession and data continue to weaken in the US, what happens to asset prices across the board? And this is potentially why we're seeing silver and gold going back up again. So that draws us to the end of Macro Monday. So hopefully you enjoyed us. Thanks for joining us this week and have a great week ahead. Thank you.
Thank you.